Do you want to become a real estate investor but worried about making costly mistakes? Today, I'm going to reveal the 5 most common mistakes of real estate investors and how you can avoid them. If you're new to my channel, I work as a finance manager at a top tech company with an MBA in finance and a CPA designation. I've come across these common mistakes in my own journey of investing in real estate and as a CPA who reviewed and advised my clients on their real estate deals. So without any further ado, let's go through these 5 mistakes one by one. Mistake number 1, not researching properly. Before you make a purchase, you have to know the local market, the neighborhood, and analyze values of similar properties. This means looking into recent sales, rental rates, crime rates, and any potential HOA rules in the community. If you're not properly informed before the purchase, you may find new information about the property only after you buy it and then may regret your decision later. Mistake number 2, underestimating expenses. New investors usually get excited when they see that the rental income is just a bit higher than their mortgage and tax payments. For example, if the rental income is $2,100 a month and the mortgage and tax payments are only $2,000, then an investor will think that it's a good deal. The renter is basically paying off your mortgage and there's also $100 in profit. But then other costs come up. Insurance, repairs, maintenance, HOA fees, and property management. And the worst surprise for new investors is vacancies. Some of the month, the property might be staying empty and not making you rental income while you still have to make the mortgage and tax payments on it. Mistake number 3, only considering rental income. This is kind of the opposite of mistake number 2. The beauty of real estate investing is that your property has a high chance of increasing in value over time. So when making your investment decisions, don't only think of how much rent you're going to make. You should also make some educated assumptions on how much the property will increase in value. This calculation will help you avoid missing out on good real estate deals. Mistake number 4, poor property inspection. Not doing a thorough property inspection can lead to costly surprises. In recent years, out-of-state investing has become extremely popular. Out-of-state investing is when you buy cheaper properties in other states that have lower cost of living. Usually, out-of-state investors don't even see the properties in person, and only after closing, they end up discovering significant issues. So make sure to always conduct a detailed inspection to avoid buying a property with hidden problems. And if you're an out-of-state investor, try traveling to that state at least for a few days to check out the property in person. Mistake number 5, large loans and no cash reserves. Taking on too much debt can become a huge problem in real estate investing. So that is one of the main things I always look into when people ask for my advice as a CPA. I never advise any of my clients to use all their cash and max out their credit when purchasing properties. Any unexpected repairs, vacancies, or a job loss can make you struggle to cover the cost of the property, which can lead to foreclosure and losing your property to the bank. So these are 5 most common mistakes that you should avoid if you want to become a real estate investor. I hope you found this video helpful and let me know in the comments if you have any questions. Thank you for watching this video and I'll see you in the next one.